Relationship between base rate and exchange rate. In this video, we will discuss the impact of changes in the base rate on the exchange rate, and how these two key factors are interrelated. One. Understanding base rate. The base rate, also known as the benchmark interest rate, is the rate at which the central bank lends money to commercial banks. It is a key monetary policy tool used by central banks to manage inflation, economic growth, and financial stability. Changes in the base rate can have a significant impact on the economy and financial markets. 2. Understanding exchange rate. The exchange rate is the value of one currency in relation to another. It is determined by the demand and supply of currencies in the global foreign exchange market. The exchange rate is affected by various factors, including economic growth, inflation, political stability, and global trade. 3. The relationship between base rate and exchange rate. The relationship between base rate and exchange rate is complex and dynamic. Changes in the base rate can affect the exchange rate in several ways. Higher base rate leads to stronger currency. When the central bank increases the base rate, it makes borrowing more expensive for commercial banks, which leads to higher lending rates for businesses and consumers. This can reduce borrowing and spending, leading to slower economic growth and lower inflation. However, it can also increase demand for the currency, leading to a stronger exchange rate. Lower base rate leads to weaker currency. When the central bank lowers the base rate, it makes borrowing cheaper for commercial banks, which leads to lower lending rates for businesses and consumers. This can increase borrowing and spending, leading to faster economic growth and higher inflation. However, it can also decrease demand for the currency, leading to a weaker exchange rate. Expectations and market sentiments. Expectations and market sentiments can also impact the relationship between base rate and exchange rate. If investors and traders anticipate that the central bank will increase the base rate in the future, they may demand the currency more, leading to a stronger exchange rate even before the actual rate hike. Other factors such as political stability, global trade, and market liquidity can also impact the relationship between base rate and exchange rate. For example, political instability in a country can lead to a weaker currency, regardless of the base rate. 4. Case study: United States and Eurozone. Let's take a look at a case study to understand the relationship between base rate and exchange rate in practice. The United States and the Eurozone are two of the world's largest economies, and changes in their base rates can impact the global financial markets. In March 2020, the Federal Reserve of the United States lowered the base rate to near zero, in response to the economic impact of the COVID-19 pandemic. This led to a weaker US dollar, as investors sought higher yields in other currencies. Meanwhile, the European Central Bank kept its base rate unchanged, leading to a stronger euro. However, in December 2020, the Federal Reserve announced that it would keep the base rate unchanged for the foreseeable future, leading to a stronger US dollar. In conclusion, the relationship between base rate and exchange rate is complex and interrelated. Changes in the base rate can impact the exchange rate in various ways, depending on the economic conditions and market sentiments. It is important for investors and traders to keep an eye on both factors and their potential impacts on the global financial markets. Thank you for watching this video on the relationship between base rate and exchange rate.